Firstly, for those of you who've attended some of our previous webinars and were hoping to get your regular fix of David Braithwaite this afternoon, you will have noticed that I'm definitely not David. As an advisor, David is required to attend some specific training every year to keep his knowledge up to date with all the changes that happen within the advisory world. And unfortunately, our webinar today has unexpectedly clashed with one of these. David sends his apologies and looks forward to picking up the baton at our next webinar. Clearly, with David being such a media mogul, standing in for him hosting this today means I'm trying to fill rather expert shoes. And if you've met David, you'll know they are indeed very large expert shoes. If you've never met David or I, don't worry. If you've ever seen the movie Twins with Arnold Schwarzenegger and Danny DeVito, then that's just summed up David and I. But what I will do is promise to do my very best to navigate you through our inheritance tax webinar. So talking about inheritance tax can be tricky. Daniel Craig was somewhat shaken and stirred the debate in the past, stating that he was planning on spending or giving away most of his fortune rather than leaving it to his children. And in fact, when we sent the invites out to the webinar, we had a lovely tongue-in-cheek response from one of our clients who said that they would love to attend today, but they couldn't make it because they were out spending their son's inheritance. But for some of us, once we've had our fun, we would like to pass some of the wealth onto our children and loved ones. And whilst we won't all be lucky enough to amass some of the figures that 007 might, it doesn't necessarily mean we'll avoid the issue of inheritance tax and passing on our wealth. So to help, we wanted to put on a webinar to look at the size of the issue. We'll start at the beginning. What is inheritance tax? How does it work? What do you need to think about and how will it affect you? And lots more too. But importantly as well, what are the actions we can take to make sure we're not giving away more than we need to? So with the help of our panelists, we'll take a good look, drawing on their experiences and their expertise. And then we're going to provide some practical takeaways on what you can do. As Kelly mentioned, we'll also have space for your questions and answers at the end. There's rather a lot to cover, so I'll start by introducing our panelists. First up, we have Jim Cavey, Senior Business Development Manager at Octopus Investments. Jim graduated from Exeter University in 2008 with a Mathematics with Finance degree and has worked at Octopus for the last 10 years, helping and working with financial advisors to find solutions for their clients' inheritance tax problems. Then we also have Craig Brady joining the panel. Craig's one of our senior financial advisors at Citrus Financial and has worked in the financial services industry since he graduated with a first-class honours economics degree in 2009. He's been with us since 2016 and has a wealth of experience in advising clients on this subject. So let's get started. Jim, I'm going to come to you first. So what exactly is inheritance tax?
Yeah, so inheritance tax. Yeah, not the most joyous of topics to talk about on a Friday afternoon, but one that we must talk about nonetheless. So when you do sadly pass away, your estate is what is left behind. Now, your estate is effectively everything that you own. So that will include your house, any savings you've built up over the years, any investments, and any other type of assets that you own that are in your name. And then the inheritance tax, is paid on the value of that estate when you do leave it behind and when you do pass away. Not everyone is required to pay that tax. So the government do very kindly give everyone some allowances. So the inheritance tax-free allowance for each individual in the UK is £325,000. Anything over and above that, the inheritance tax rate in the UK at the moment is at 40%. So everything over and above that, not only will you pay tax during your lifetime, but you will also then pay 40% inheritance tax when you do pass away. There are some things that you can put in place to avoid that and mitigate that. But in real simple terms, that is what the inheritance tax relief in the UK regime, the inheritance tax regime looks like in the UK currently.
Okay, thanks, Jim. So I guess that's the basics, but I'm also guessing there's more we need to be aware of. So how does it actually work?
So that is the nil rate band that I mentioned earlier, the 325,000. And hopefully you can see that on the screen. As is often the case with UK tax allowances, it can get quite complicated and complex, which is why it's definitely worth speaking to someone like Craig about your particular situation. And what the government decided to do back in 2017 was to introduce an additional allowance. Now, they called this the residence nil rate band. And this is an extra allowance, but it's only applicable to your main residence. So there's some complications and nuances to that. That got phased in, as you can see on the slide here. So it now currently sits at £175,000. So a total of £500,000, provided you can offset some of that against a main residence, i.e. your home. There are some nuances just to be aware of. The government didn't want to give this allowance to everyone. So obviously it is quite limited to people that do own a property. So if you don't own a property, then there can be some complications there. You do also need to have direct descendants. So son or daughter, not niece or nephew or friends. You do need to be able to pass on your estate to direct descendants. And then also your total estate that I mentioned earlier, so everything that you own, all of your assets, needs to be less than 2 million. As soon as, if everything you add up is more than 2 million, so your house and investments and savings, then you do actually start to lose some of that extra residence nil rate band. So yeah, as you can see, hopefully some insightful information there, and it does go to show that it is quite complicated. But there are some ways that you can help plan around those allowances.
Okay, thanks, Jim. And does marital status influence how inheritance tax is calculated?
Yeah, exactly right. So that allowance, that initial allowance I mentioned at the beginning, your nil rate band, 325,000, that is for each individual. So everyone has their own nil rate band. If you're single or unmarried, then you can't partner up and use both of your allowances. If you are, then you can transfer over your nil rate band. So effectively, you have a combined allowance of £650,000. And again, for married couples, on first death, assets can be passed to the surviving spouse, to your surviving spouse, free of inheritance tax at that point.
Okay. Thank you. Really helpful. I guess just listening to some of those numbers, Jim, some of them seem quite large. So is this really an issue for many of us, or is it just something, frankly, the rich need to worry about?
Yeah, so that's a good question. So I think gone are the days where inheritance tax was just for the super wealthy and high net worths to pay. It really is a tax, quite a hidden and unknown tax that HMRC do profit from. We have had a number of things to create this sort of perfect storm for inheritance tax receipts to be paid to HMRC increase over the years. So first of which is that residence nil rate band that I just mentioned of 325,000. That was first introduced a number of years ago. And what typically happens is allowances will get increased over time in line with inflation. That hasn't happened. That's been frozen. And those allowances are due to remain frozen until 2026. So you would have thought those allowances would have increased over the years, but they haven't. And then compounded with that issue, you do also have the fact that house prices have continued to rise. Other assets, investments over the medium to long term have also continued to rise. So when you just look at an average house price of houses in the southeast of England, you can see you can quite quickly eat up the majority of your nil rate band just by having a relatively modest size house, and that's not even getting started on investments and savings. So you can see here even HMRC themselves have budgeted and sort of predicted that in the tax year 25-26 they are estimating that they will collect nearly £7 billion in inheritance tax, which is significantly up from a couple of years ago. And yeah, you don't have to go too far to look for any up-to-date data and stats on the fact that they are continuing to see an increase in those IHT bills being paid.
Yeah, thanks, Jim. And I do think, the majority of people on this webinar are based in the southeast. So property prices alone make this sound like a real issue, especially with the thresholds frozen. In fact, I was reading one of the National's newspapers on Sunday, and there's an article in there on it's actually labelled "The Tax Grab on Inheritance" from the Office of Budget Responsibilities, the latest numbers. And actually, they're now calculating the 25-26 tax grab, as they call it, to come out at about 7.8 billion. So it just goes to show how that figure is increasing as property prices just keep going up. Super.
Absolutely.
Thank you very much indeed. Craig, it's probably time I came over to you. So, do you think most of your clients realise that inheritance tax is an issue for them?
Yeah, I think more and more nowadays, there's a lot more in the press about inheritance tax. So a lot of clients are aware of that and see the articles. But there's still this, as you've just touched on, public perception that inheritance tax is for the rich. So a lot of people don't realise the size of their estates as they're kind of, you've touched on the property prices, and as they've accumulated wealth, they may not realise that they're actually in breach of that limit. Okay. And what type of people do you talk to about inheritance tax? I'd say everyone, really, all clients at all stages of their life. So, the younger clients, the clients that are accumulating wealth, it's always something to bear in mind. Obviously, they'll have different objectives at the time. They'll be saving for a purpose, but it's something you'll touch base with them. They'll obviously have parents. They might be expecting the inheritance themselves. So that's something to, keep in mind. And as you get to the other end where you retire, you can start spending your savings. Again, a lot of people save for retirement, won't realise how much they're going to spend, will maybe plan to spend it all, and then they'll get to that stage of life and realise, actually, I've now got an issue. Okay. And thinking about what you just said, so there's clients coming in from their 20s through to their 60s, 70s, 80s, different priorities, but actually, is there a best time to think about inheritance tax planning, a typical age or stage of life? Yeah, not really. I mean, with all financial planning, the earlier you start, the better. Obviously, with inheritance tax, slightly different in terms of everyone, I'm thinking about it now for myself personally, it's not going to be number one priority. I've got a young family, they're going to be the priority. So it all depends your stage of life. There used to be a perception that you had to kind of plan earlier because of the 7-year rule on gifts. Obviously, there's now particular investments you can do where you only have to survive 2 years. So really, there's no correct age to start planning, but you can. A lot of people get to their 80s and think there's nothing I can do now. I'm too old, and that is not the case. Okay, just maybe tell us a little bit more. So you just referenced there the 7-year rule around gifts. Yeah, so if you give money to someone, or if you set up a trust and give money into a trust, the person making that gift, they have to survive 7 years before the funds completely fall out of your taxable estate for inheritance tax. Whereas there are investments you can make where within 2 years that money is outside of your estate. Okay, thank you. So we've now got some, we've been through the basics from Jim, now something to understand about clients that come in to see you and when you might start to talk to those clients about inheritance tax planning. Yes, now we've got this piece that says, well, what sort of sums are involved? So Jim, maybe you've got a couple of examples we could look at around typical IHT situations.
Yeah, sure. And again, just to bring it to life a little bit, yeah, we've got a few examples and how those allowances do come into play in real life. And it just goes to show, yeah, you don't have to have a mansion to have a real IHT situation. So in this scenario here, we're going to look at a lady who is single. And she doesn't have any children, so her beneficiaries are her niece and nephew, who she loves dearly, and would rather they had as much of her estate upon her passing away rather than Rishi Sunak, because she feels like she's already paid him more than enough tax in her lifetime. So her house is worth 300,000. So yeah, a modest sized house in the southeast of England, I would suggest. She's built up savings of 100,000. She's got investments of 75,000. That could be within the ISA wrapper, which is clearly very tax efficient during life, but not potentially on death from an inheritance tax point of view. And then another £25,000. So her total estate added all up comes to a nice round figure of £500,000. Her nil rate band that I mentioned, she'll have one nil rate band of £325,000. She will not have the residence nil rate band because she does not have direct descendants. So she is one of these people that falls within this trap of people that don't benefit from that extra allowance that they introduced a few years ago. And so the amount completely liable to IHT for her and her beneficiaries is £175,000. So 40% of that equates to £70,000. So her beneficiaries, upon her death, will have to find £70,000 to pay to HMRC, in terms of an inheritance tax bill. So that's one example of someone that I would say is a relatively modest estate, but definitely falls foul into the IHT trap. If we then do look at a married couple, Mr. and Mrs. Brown, again, we are using an example here where they don't have children, so the beneficiaries are their three nephews. So their house is 600,000. They have also built up savings and investments of about 300,000. So their total estate comes to just under £1 million. So there's a lot in the media, or there was a lot in the media a few years ago about the new residence nil rate band, which the Tories were sort of marketing as a £1 million threshold for inheritance tax relief. So some of the people dialing in today might recall the £1 million threshold. That is based on a married couple who do have the residence nil rate band. So this couple here might be thinking, well, we have an estate that's worth less than £1 million, but because they don't benefit from the residence nil rate band, they still will have £275,000 over and above the normal standard nil rate band for the two of them, meaning that they're going to have a tax bill of £110,000 upon their death. So yeah, just worth pointing out that the reason we use this example is lots of people might have heard of that £1 million threshold that got introduced a few years ago.
Thanks, Jim. That's helpful. I mean, these figures seem really sizable, and your point earlier, and for people who may well feel like they've paid enough tax during their lifetime, yet alone to pay these kind of sums on death. So Craig, I suppose my question to you is, look, amongst friends here, do we have to pay this? How would the government know if we didn't, if we just gone and sort of dug a hole and buried it in the garden somewhere, etc.? Who would know that we have this amount of money we owe?
Yeah, so legally you have to report it, you have to pay it, like all kind of self-assessment tax. So it will fall on the executors of the will. When you apply for probate, you will have to estimate the estate's value. Obviously, if the individual doing that decided to mislead the government and devalue the estate so there's no tax, whether the government will find out or not, who knows? They do spot checks. I have had slightly different with capital gains tax, a client who didn't realise she had to pay it, got pulled up on it 5 years later. So they definitely look into these things. So yes, you do have to pay it. Okay,
thank you. So we know it's ethically right and responsible to pay it. You just talked a bit about then. So when's the money actually due? How do you pay the bill?
Yeah, so the executor, when applying for probate, will have to like I touched on a moment ago, will have to estimate the estate's value. So you do that and report that to the government. There'll be a form to complete. If that then triggers that there is an inheritance tax liability, you actually have to pay the bill before you are granted the probate. So it will fall on the executor to pay that bill. Sometimes if they haven't got the funds or they're reliant on a property sale from the estate, banks may consider lending the money. HMRC can consider giving you kind of a loan to pay back once the probate is granted, but it will have to be funded, before probate.
Okay, thanks, Craig. So I guess now we've heard from Jim telling us the types of amounts that we might be facing into with our inheritance tax bill. We now know how to pay it and when we're going to have to pay it. So now, importantly, what planning can we do to reduce the size of the bill? Where do we start?
Yeah, I mean, obviously there's a variety of different solutions and it will all come down to the individual client and their circumstances. Obviously, kind of the first thing you should think about is making sure your will's correct, making sure that you're making use of all of these allowances. And then really, I'd always say to clients, the first thing is knowing exactly what you got, valuing all of your assets, all your savings, investments, pensions, debts, and more importantly, letting your loved ones know exactly what you have. Because a lot of the time we see clients fall ill or pass away and their beneficiaries don't really know their circumstances, don't really know what they got. So I'd always say jot that down, make sure we know that as advisors and your nearest and dearest know that. And then obviously there's a variety of different solutions that you can come talk to us about.
Okay, so in terms of preparation, it's really thinking about how they want the estate to, to potentially to be allocated. Must consider that. And then if I come to talk to you about inheritance tax, what else do I need to prepare before I come and see you?
Yeah, so I'll need to know everything about you really. So, knowing your client, all your savings, investments, assets, personal details, children's details, grandchildren's details, so on and so forth. And then it will be really a discussion point, given the size of the estate, what options are available. I've touched on earlier the investment side. Now, the investment side can work really well because the money remains yours. That's a big thing with inheritance tax. With trusts and gifts, you lose that money. It's not yours. So by going down the investment side, you get to retain control of that money. And that can be really important to people. Obviously, spending it's one thing that I keep telling my retired clients: spend the money. A lot of people find it hard spending their money that they've worked their whole life to save up. So yeah, it will all be client dependent based on that circumstances. They'll have other objectives. It won't just be inheritance tax planning. So yeah.
Okay, so making sure spending, that's a really interesting one. So come on, if the clients you see, you talk about spending the money, and this is where you be interesting to with your experience. So typically, do people do take that approach and go, great, I'll go and spend, or actually, are you finding that most clients go, okay, let's understand what my options are here, and then let's do something to
yeah, I think you find especially with retired clients, they find it hard spending their money. They find it hard, they've built up this pot over the years, and they still remain quite frugal. Their lifestyle doesn't drastically change when they retire for most people. So then suddenly they've had this intention all their life of building up this savings pot to spend. They get to their early 70s and realization is, okay, maybe I'm not going to spend it all. You value the estate. Okay, well, this is your liability at the moment. And then, you can run through the options. You can run through investments. Another important thing, pensions. Pensions are outside of your estate for inheritance tax. So funny enough, when it actually comes to, spending your money, the pension should be the last thing you touch, which is quite strange because most people think that's where you start because it's called a pension. But from a tax point of view, you touch all your other savings and investments first before you move on to the pensions, if inheritance tax is your ultimate goal.
Can I just add on something to there as well, Richard, as well, is I'd echo everything that Craig said in terms of when I speak to advisors and clients not being able to spend money, that then sort of flips at a certain point when the conversation develops into paying for care home costs, care home fees. So that is then when it suddenly becomes very easy to spend money on care home fees in the southeast of England. And so making sure you're speaking to Craig and financial advisor around building that plan to make sure you do have enough money and you can turn on taps to generate an income potentially down the line. That is then where you sort of go from this inflection point of not being able to spend it to actually I do need to spend it because I'm going into a care home where it's going to cost 50 80, £100,000 a year, depending on what sort of level of care you need or want and can afford.
Thanks, Jim. Yeah, these are the huge numbers, aren't they, for care costs? So it's a really good point. Thank you. And I'm really mindful we have got a number of questions now coming in, which is fantastic. And we're going to allow time to ask some of those. So Craig, before I move on to Q&As, tips that you'd like to leave us with?
Yeah, so you're going to bring up the screen for the top 5 tips. So firstly, obviously, will. So make sure you have a will in the first place to make sure that, you know, the people that you want to benefit will benefit and that you're making use of all of your allowances. Then, you know, use your existing savings, investments, pensions. So we touched on, you know, your pension pot that's outside of your estate. So, you know, draw in on your existing savings and investments first. If you do have an inheritance tax liability, and with planning, you know, we've touched on there are investments you can do in order to get it outside of your estate within the 2-year period. Another option is a product called whole of life insurance. Now, this is life insurance where you'll pay a monthly premium. It'll be for the rest of your life. And normally you tailor it so that the payout will be the inheritance tax liability. So that way, on death, the product pays out. And that goes straight to the executors, and they can then pay the inheritance tax. So they don't have to sell anything within the estate to pay that bill. So that's something worth thinking about. Obviously, gifting, you get £3,000 per year, you know, annual allowance in terms of gifts. Anything extra, you know, will start the 7-year clock. So if you want to go down the gifting route, then the earlier you start with the gifting, the better, because obviously you have to survive the 7 years. And the same applies to trusts. So that falls under the 7-year time period. So again, that is something you want to plan for earlier, if that option, you know, is the right option for you.
Okay, thank you. Really interesting points for people to think about. And I suppose just listening to you and what Jim said so far, the other bit that strikes me is actually this is quite personal in terms of preferences, priorities, and potential strategies. So it's that whole point over what works for one may not be right for another. Therefore, it's about how it's individually approached.
Yeah, precisely that.
Thank you. Right, I am going to move on to questions because they are building up a lot, which is great. Thank you so much, everyone, for these questions. Craig, I'm going to come to you first of all.
Okay.
So I have questions relating to what is included for tax purposes. I have ISAs and a drawdown facility against what was originally my pension pot. Do the ISAs and remaining drawdown pot get included? Okay,
so I think that client is asking, are ISAs and pensions included inside your taxable estate for inheritance tax? So the answer to that is ISAs are. So ISAs are included. So some clients, you know, are led to believe that, you know, the ISA is tax-free, on death it will just pass tax-free. That's not the case. It will be included inside your estate. You can actually, on first death with a married couple, the surviving spouse will get an uplifted ISA allowance in the year of death. So in theory, you know, from first death to the surviving spouse, that can pass across. But on the second death, that will be included inside your taxable estate for inheritance tax, whereas pensions are completely outside. So that's why if you're just planning purely for inheritance tax reasons, the pension is the last investment you touch in terms of drawing money out, because all of that is free of inheritance tax.
Perfect. Okay, thank you very much. And Jim, probably this one's for you. Do both people in a couple get 175,000 each? In terms of
yeah. So that's for their residence nil rate band. Yeah. So both of them would have an additional residence nil rate band, provided they meet those other criteria around direct descendants and their estate being less than 2 million, etc. So, yeah.
Okay, thank you. And I might stay with you on this one. This is an interesting one that's come in. So for those that didn't see it, I was watching Millionaire Porn last night, and a guy had invested in watches. So for those that didn't see it, a gentleman had a range of Rolex watches he'd invested in. Would they form part of an estate, or is that a good example of maybe something that could just be, you know, forgotten about? And
yeah, so it's a good question. So yeah, things like jewelry, watches, statues, work of art, they definitely would form part of the estate. I did actually see an article which I've got here, so I can just share it. So in the last financial year, HMRC did actually do an additional 3,600 inheritance tax investigations. and from that, they did see an extra £254 million being claimed. That if you then break that 254 million across all of those different investigations, that was an additional £71,000 worth of extra IHT that clients were trying to sort of squirrel away behind the sofa, that HMRC did find out about. So worth being aware of. Obviously, off the back of Brexit, the war, inflation, COVID, HMRC are keen to make sure that they are capturing as much tax as they possibly can from people.
Yeah, noted. Thank you very much. And Craig, you talked earlier about wills and the importance of wills. How is it to arrange a will? Is it just something you can do? You've done it once, you put it away, and it's dealt with.
Yeah, no, a will is something that should be reviewed, yearly as people's circumstances change. So doing a will fairly straightforward if you know what you're doing. So we offer a will writing service. There's various different firms out there that'll do the same. So that is definitely something that should continue to be reviewed, because people's circumstances change, tax rules change. So for example, the nil rate band didn't used to be transferable between spouses. So if you did a will 20 years ago, a lot of solicitors would have advised, make sure you use that 325,000 on first death, because if you don't use that, you lose it. So typically you'd create a trust, leave that 325 someone else, then leave the rest to your spouse. So you've used that allowance. Obviously then the rules change, they're transferable, you don't have to do that anymore. So a will is definitely something you should review year on year.
And just listening to you, it strikes me that one of the reasons behind that is you've talked about the number of times something changes. So it sounds like you can, you set something up one year, and actually it is quite important to review it again the next year in case something has changed, either for you or from a regulatory perspective.
Yeah, exactly that. I mean, people name executors, people move, don't they? People move around the country. You want to make sure that they're still close to you. People have family disputes, family fallouts. You want to make sure that no one's benefiting who you now don't get on with. Allowances change. The residence nil rate ban that was introduced, that was a new rule. So you want to make sure you're leaving your property to a direct descendant if you have one, otherwise you'd lose that allowance. So rules change all the time, so you just need to make sure you keep on top of it.
Okay, thank you. And we've talked about potentially some valuables and what might count within an estate. What about if I want to leave my money to charity? And I don't know whether this is best for you, Craig, or for Jim, but if I leave money to charity, is that money included in my estate?
Yeah, so I can answer that. So it's not. So that comes off the value of the estate. So any money left to charity will come out. Okay.
All right. Thank you. And Craig, just picking up on something you mentioned earlier as well, you talked about ISAs. I think, we have perception about ISAs and their tax efficiency. But you said that maybe they're not tax efficient when thinking about inheritance tax. So just remind us again why that's the case, please.
Yeah, so purely with inheritance tax, ISAs are very straightforward in terms of, you pay the money in, the money then grows within that ISA wrapper tax-free. And when you want the money out, it's tax-free. So it's very straightforward, for clients to understand. On first death with ISAs, so take married couple example, the surviving spouse will get an uplifted allowance as the value of their deceased spouse at the date of death. So effectively, now on first death, you can kind of retain that ISA. It just gets passed to the spouse and, can be one in their name. However, on second death, that is when it will fall inside the estate. So if the client's unmarried, it falls inside the estate on first death. If they're married, it will be second death.
Okay, thank you very much. And I'm going to stay with you just for a second, if I may. Trust, because that's something else you mentioned briefly as well. So how do trusts work?
So trusts are fairly complicated. The easiest way for a client to look at it is like a gift. So to set the trust up, you'll gift money or assets into a trust. You will then lose control over that asset. It's no longer yours. It will be owned by the trust, and you will name who you want to benefit from that trust. So there's a variety of different trusts. It will really be client dependent on their situation, whether that's appropriate or not. But simplest way to look at it, you still have to survive the 7 years, and you lose access to that fund. It's not yours anymore. So that's the big thing with trusts, and for people to realise that it is permanent and you lose that asset.
Okay, and is that linked to one of the other things you hear about? Lots of people saying, "Well, I know what I do. I'll just put my house in a trust or gift it to the kids, and I'll just carry on living here, and surely that's it. Then they own it, and everyone's happy." Is that a solution?
So that are solutions that people have used in the past. You know, if you put your property into a trust, like I just said, it's then not yours. So you lose access to it. If Jim touched on care. You won't be able to draw on your house, you won't be able to sell it, you won't be able to, if you change circumstances, you won't be able to remortgage. But if you do it and survive 7 years and it's in the trust, then it is outside of your estate. So that's kind of the advantage. Get it from a lot of clients say, okay, well, put the house just in the kid's name now. And obviously if you survive 7 years, great. If you do that, and you remain in the property, you will have to pay rent at market rate. Otherwise it will fall back inside your estate as a gift with reservation. So it's something for people to be mindful of. You can't just gift your assets away and still benefit from them.
Okay. What was that market rate you mentioned?
So it'll have to be at market rate.
At market rate. Okay.
Yeah, so if you put your property in your children's name, you will have to pay them rent at the going rate. If you pay nominal, £50 a month, then it will fall back inside your estate.
Okay. All right. Thank you. And on the subject of homes, holiday homes abroad. Question on what happens if you own a holiday home abroad, does that get included?
Yeah, so it's with UK tax, it is your worldwide assets as long as you're a UK resident. So yes, it will get included.
Okay, thank you. Jim, I'm just going to double check on this one because I know we had a question before about 175,000 limit as well. With 175,000 though, if you have children, is it only one allowance or ×2 for a couple?
Yeah, so I saw that question come in. Yeah, so I think it's the same question. It's you get two, husband and wife, you'll get your individual nil rate band of 325,000, and then you'll have both additional residence nil rate band for a couple, provided you do have direct descendants and your estate isn't worth over £2 million.
Okay. All right. Thank you. Maybe Jim, just stay with you for this one. So we've talked a little bit about how you pay inheritance tax and the calculations of what the value is. Do you know how long you get? I mean, what happens if it's based on a property and it takes time to sell a property and things like that? Do they start clamping down after a certain amount of time?
That's probably a question for Craig, actually, if I can defer to Craig as the advisor.
Yeah, sure. Okay. So with that question, it all depends on how complex the estate is. So like I touched on earlier, you have to complete that before probate. HMRC want the money before they issue probate. Obviously, it comes down to that client circumstances, how, like I said, how complex their estate is. What you'll find is if it's kind of property dependent and you can't sell the property, they will cut you some slack. They will, some banks will loan against it, or HMRC will kind of give you a loan that you'll pay back in installments. So there is flexibility there. But in an ideal world, you'd have the liquid funds to pay that bill because it'd make everything more straightforward. Perfect.
Okay. Thank you very much. You'll be pleased to know, I think we have gone through most of the questions now. Don't think there's anything else here to ask. We talked about that. So thank you very much to both of you because I've rapid fired questions at you there and you've managed to work your way through them all. Probably one that's just come in actually, just to make sure. So valuing the size of an estate, can we just be clear? How does the government know what the actual size of an estate is? So if you've got valuable belongings and things like that, how do you know? How does the government know?
So it's up to the executors to estimate the estate's value. So you'll go through paperwork. I mean, it tends to be online nowadays, and you will have to declare everything. So it'll be up to that individual declaring it. And like Jim touched on, HMRC can investigate if they don't think that's a true value. So you just have to be as honest as possible. In relation to property, you would have to get the property valued. I suspect with expensive items such as jewellery, artwork, again, you might want a professional's value to make sure you're right. So that's all correct. So it will fall on that individual, and then it's up to HMRC if they want to then investigate.
Okay, perfect. Thank you. And I lied to you because we've now had a couple more questions come in. So don't stop yet. So obviously, we talked about inheritance tax and what happens to the person potentially paying or the estate paying the tax. What about allowances for children receiving inheritance? What's the tax implications there?
So let me just get the question right. So is that if the proceeds go straight to the children?
Yes.
But typically with children involved, there'd be a trust set up, typically speaking. So the will would set that up. The will would stay at what age they want the children to benefit from. It would also name the trustees of the trust. And then it'd be up to the trustees to then manage that money on behalf of the children until they reach that age. So effectively what would happen in terms of the estate, they'd value the estate. If there is an inheritance tax liability, that still needs to be paid. And then the proceeds would go into a trust for the children, be managed by the trustees, and then would pay out when the children reach a certain age.
And if there wasn't a trust and the children received the money directly from the estate,
yes.
Assuming inheritance tax are being paid, is there further tax potentially due by the dependents receiving that money if they are already perhaps taxpayers in their own right as well?
Yeah, so they won't be. So on death, it's just inheritance tax on the estate. Once the actual proceeds are paid out and the tax bill's been paid, then obviously the money's the beneficiaries, that'd be the children's. So then obviously they would then have to bear in mind their own inheritance tax situation. And I think that's what we're getting more of now. We're seeing clients, the longer people are living, people are inheriting money a lot later in life, past the point of those people needing the money, to be honest. So we're seeing a lot of retired clients, into their early 70s, late 70s even, still have parents going, have suddenly got a relatively large inheritance to come because of the price, property prices in the southeast. And then suddenly they can go all through their life thinking, they're nowhere near the threshold. Then, their dad passes away. Suddenly they've got 800,000 in terms of property that gets passed them. Suddenly they have an inheritance tax issue.
Okay. Craig, can I ask a quick question? So I work for Octopus Investment, so I am more on the side of the investments that can qualify for IHT. So I'm definitely not a pension expert, but is it worth just touching on for the viewers, as it were? You've mentioned pensions obviously are free from IHT, but am I right in thinking once clients get to a certain age, I think it's 75, when then the children, and the reason I'm asking it is kind of linked to the question, is the children can inherit the pension tax free, but then they will have to pay tax on anything they take out of the pension. Is that right?
Yeah,
or
that's correct. Yeah, so 75 is the magic number. So if you die before 75 with a pension, the proceeds are tax free. After 75 is taxable on that individual. However, most modern pensions now give you the option for that person to keep it in a pension wrapper. Obviously, everything they then draw from the pension will be taxable at their marginal rate of income tax.
Okay.
Super. Thanks for good question, and thanks for clarifying, Craig. Craig, we're down to 1 minute. I've got at least one more question. I'm going to try and get a really quick answer from you. So what's the view on using insurance to pay inheritance tax? You talked about the 5 things maybe we should think about earlier. Is the insurance typically expensive? Yeah, so the easiest way to look at whole life insurance is it is kind of an investment. So with term insurance, which people will be familiar with their mortgages, you hope you never have to claim on it. You hope it's wasted money because, you hope you're paying it per month, never have to claim on it. And when you get to, your mortgage is gone, that insurance goes. With whole life insurance, it is an investment. There is a guaranteed payout at the end because you'll be paying that premium until you pass away. So what we tend to do is we'll do a calculation to show you, well, this is how long you'd have to survive before you'll break even. Okay, thank you. So again, worth kind of speaking to an individual and then pricing it from there. So that's useful. Thank you to know. We are literally timed out. So I will pause there. There may be a couple of questions still that we need to answer separately, which I promise you we will come back to you on that. Actually, with all these things that we do, it's often the questions that really help bring the topic to life. So I really appreciate all the questions coming in. Thank you. Our next event is likely to be about retirement planning, because that's another topic we're being asked about an awful lot at present, and we'll be announcing the date shortly. So in the meantime, my thanks to Jim, my thanks to Craig, to Kelly, and to Simon for all of their help in putting today's event on. Thank you so much again for everybody that's joined us this afternoon. I hope you have a brilliant weekend when it arrives. We will provide a copy of the video, make that available for you. And again, we'll follow up any further questions and answers with you as well. So in the meantime, thanks ever so much again, and please take care.